can extrinsic value gaps reveal mispriced options for arbitrage? Imagine spotting a price difference that seems too good to be true in the options market. That's what extrinsic value gaps can sometimes show us. When two options on the same stock with similar strike prices and expiration dates have very different extrinsic values, it might mean one of them is mispriced. Extrinsic value is the part of the option premium that covers potential future gains based on time left and expected volatility. If one option has a much higher extrinsic value than it should, compared to a similar option, traders can step in to take advantage. They might buy the underpriced option and sell the overpriced one, locking in a profit as prices move toward their true value. To understand this better, think about how options are priced. The total price of an option is made up of intrinsic value, which is the immediate profit if exercised now, and extrinsic value, which is like a premium for what might happen in the future. Extrinsic value depends a lot on how much time is left until expiration and how volatile the stock is expected to be. If two options have the same strike price and expiration date but one has a much higher extrinsic value, it could be because of market inefficiencies or different trader expectations. For example, if a near-term call option has a very high extrinsic value compared to a longer-term call with the same strike, it might be overpriced. Traders can sell that overvalued option and buy the cheaper one with more time remaining. As time passes and volatility normalizes, the extrinsic value should decrease, and the prices will come closer together. This creates an opportunity for arbitrage, which is a riskless profit from price differences. Factors that cause these gaps include differences in implied volatility assumptions, market demand, and liquidity. If traders see that one option's implied volatility is higher than justified, it can inflate its extrinsic value. Sometimes, market makers might overprice options to hedge against risk or due to supply and demand imbalances. When these gaps appear, savvy traders compare the implied extrinsic value to theoretical models, like the Black-Scholes model, to spot inconsistencies. They then execute strategies like calendar spreads, where they sell the overpriced short-term option and buy the cheaper longer-term one. As the short-term option's extrinsic value decays faster, the trade profits from the convergence. These gaps are like signals that the market has temporarily mispriced the options, giving traders a chance to profit from the correction. In essence, extrinsic value gaps act as clues to mispricings in the options market. They show where the market might be overestimating or underestimating future volatility or time value. Traders who understand these differences can set up trades that benefit from the eventual alignment of prices, turning market inefficiencies into opportunities for profit.